Well, there are no dumb questions on this podcast. At least we hope there's not. Episode number 5. We've made it this far, along with Doug Flynn. I'm Connell McShane. And, we're going to look at the year end as we're coming up on the year end, Doug, to talk about taxes, because this idea, and you do it on my show on News Nation every Tuesday, the world famous Tax Tips Tuesday with Doug Flynn, is, people start thinking about how much they're going to pay, and then also how much they can save. I wonder, sometimes you start to think this is just for rich people, but it's not necessarily. It's a little bit of for everybody, right? In terms of how you should think at the end of the year, don't you think?
Definitely. And there definitely, and there are some things that you can do before the end of the year that once 12/31 comes and goes, you can't do. And I find a lot of accountants, when you sit down to do your tax return, they're looking at last year and trying to make the best of it, which is great. But they don't often do more of tax planning and saying, hey, before the end of the year, do this. And so it's a good time to take a look right now before the next couple of weeks, before the end of the year, and see if there's anything you could squeeze in here so that when you get to your accountant, they've already got a better picture to work with.
It's interesting because, like, my wife started a new job a few months ago, and when the person who was, helping her with her benefits and putting everything together was talking about retirement planning, they started talking about 401k and asking us, whether I contribute or she had contributed in the past and how much, and then got into this conversation about, and this I think applies to now, how much taxable income you could take off of your plate by increasing how much you put in your 401k. So some people just think about, hey, let me contribute as much as I possibly can just because of the savings, but then also the taxable income portion of it and how much you can save should be a big part of the conversation as well, right?
Some people get a year-end bonus, and the 401k may even be withheld on that, or you might have extra taxes. So if you have enough money to get you through the end of the year with with the holidays coming, and you don't want to pay any more in taxes, you can actually up your 401k contribution, and then you can lower it again starting in January. So you can adjust that. It's very easy to do right online with your 401k provider or through your employer. And so people will adjust if they're getting a big bonus, or if they have a lot of taxable income this year that they may not have next year. You can ramp up how much you put in there before 12/31 and then just adjust it after January.
It's only if you're coming up against one of the limits. It's just the federal limits that you look at for how much income, or, I mean, I guess depending on what state you live in too, or it depends. Sometimes it wouldn't really matter, right? If you're caught kind of in between limits, because you can only contribute, was it 20-something thousand a year? To your 401k, 23,
this
I think
year,
it is this year, something like that.
23,000, unless you're over 50, then you can do 30,500. Right, 50 or over. But I mean, the limits are somewhat different, and certainly worth a look, but primarily the federal. And keep in mind, if you're over the bracket, it's only the next dollar that's taxed at the higher rate. But it's just something to think about. If you have enough money and you don't want to pay all that money in taxes, it's a good way to defer some additional dollars. Or if you're putting into the Roth, even though there's no tax break on it, just getting more money in there for later on is a fantastic thing. We could all use more money for retirement. That's a good way to do it.
And so you do a lot of people play around, you think, with 401k contributions this time of year? But it makes sense too, because you could change them anytime, right? That's the good thing about it.
It's so easy to change. I don't know if a lot of people even think about it.
I don't think so.
No, but when working with people, I would say when it comes to bonuses, well, one, your bonus may or may not be included in the 401k contribution. Each company is different, so you need to know that. But I do see people adjusting that around if the end of the year, if they're going to get a larger lump sum and they don't really want to get taxed all that heavily on it, you could put more into the 401k.
The other thing, we all talk about 401ks because we work for private employers, but you have your own business. Or I work for a private employer. You have your own business, and then other people have, in government work, or, teaching. A lot of people have like 403Bs if you're self-employed, you might be setting up retirement plan for yourself, for your employees. So do you think about it differently if you're self-employed versus if you work for a big company? Even
Definitely.
For tax purposes?
Any self-employed person that has 1099 income, or if you have your own business where you're going to put that on a Schedule C, and it could be in addition to, a lot of people have a side hustle that they put on a Schedule C. That is,
well, we don't want to talk about your side hustle here on the podcast. Give away too many secrets. Side hustle.
Not too many.
But that is true. Yeah, another job.
Yeah, so you drive an Uber, whatever you do.
Like,
people do stuff. And that extra income, which is going to go, you're going to have your expenses, and then you're going to transfer that into your tax return on top of your other earnings.
Right.
That income is treated separately, and you can set up a self-employed retirement plan. And there's multiple plans that are worth looking into, but the best one is called an individual 401k or a single K, and that has to be opened before December 31st. Now, you don't have to fully fund it until you file your tax return next year. But what happens is a lot of people go to their accountant and they say, oh, I need a retirement plan for my business. And I'm like, now we're limited because there are a couple of plans you can go back to the prior year and set up, but the contribution levels are not anywhere near as high as setting up something like a single K or an individual 401k in, by December 31st, throw a few bucks in it to get it open, and then you can fully fund it when you file your return. So anybody who's self-employed should look into that before the end of the year. I find they don't get a lot of information or counsel on to do that. And so the single K is fantastic on you could put as much as $69,000 into that in a combination. So again, if you want to shelter a lot of that money, and some people do, they're fine with what they're earning and they just have extra income from a side business.
Yeah.
And that's a way to shelter a ton of that money, or all of it, depending on how it goes. But look into the single K individual 401k before the end of the year if you want to set that up. Once January 1st comes, can't go back and set that up for this current year. There are other plans like a SEP and a Simple you can still do, but the limits are just not as high.
No, those are really good points because, and to your earlier point, I don't think a lot of people, especially if it's not their main source of income, their main job, if they are doing something where they're getting some extra money on the side, doing whatever it is they're doing, would even think of that. It's not in their mind unless they talk to someone like you. So that's a good thing to think about this time of year. The other thing that I do think people do, at least people who are invested in the stock market and other markets, do think about this year is kind of like, selling off the losers, right? I mean, that's always the one we hear about. It's like, all right, let me look at what I have here. And it's been a pretty good year for people who own equities, certainly, right? And there's some, there's got to be one or two clunkers in here that, but that's an obvious one, right? That's what people should be thinking about this time of year, is getting rid of this, thinking about the losers to save on taxes.
Definitely. I mean, you have to take inventory on your portfolio. People don't want to look at their investment accounts when things are down a lot. And when they're up a lot, they're like, everything's up, and they don't pay as much attention because everything's doing well. But what you need to do is get in there and take a look. Hey, if I have all these securities, and we're talking about your non-deferred money, your non-401k now, a regular investment account that you pay taxes on. Yes, when you sell something. So the flip side of that is if you have something in there that's sitting at a loss, get in there. You just need to sell that before December 31st to book that loss. That can be used against any gains that you might have in the portfolio of other stuff that you've sold. Or if you have more losses than gains this year, you get to take $3,000 against ordinary income, which is a higher percentage than just capital gains taxes. And if you have $10,000 of losses, you offset your gains, you take $3,000, you carry forward any additional losses indefinitely, and every year you can chip away at it. So, if you have a big loser in there, it's not a loser if you can turn it into something positive, reinvest that money into something that moves, and take that loss. That helps you lower your taxes or offset some other income taxes and go from there. So it's a great idea to get in there, take a look. Hey, am I down on anything? Should I do something? The thing you only have to be careful about is if you sell one of those securities and want to buy exactly the same one back, you have to not do that for more than 30 days. So stay 31 days away, sell it, and you can buy it back. But you can move it into something else, like if you were down on Coke, buy Pepsi or something like that. But you can exchange into different securities. But if you can't buy the same exact one within 30 days and keep that loss. That's just a caveat you need to know.
Right. We talked about this one actually on News Nation when you were on. I probably didn't give you enough time. I always cut you off before you're done explaining these things. But no, you did explain it. We had it up on the screen, I remember. And to your point, 30-day wash rule, right? That's the rule you're talking about. That's what people refer to. And then could you this $3,000 just so I actually understand it, like going back. So could you explain that quickly this time? But what's the limit there in terms of the rules, in terms of how you can use why $3,000 matters? I think you muted yourself, Doug.
Sorry, I did. Sorry about that.
In other words, this is a kind of expert podcasting, broadcaster that you've turned into. Is you turned your mic on to cough. So our listeners,
great.
They probably enjoyed that very much. And then when you started speaking,
I muted myself.
You turned your mic on to cough, and then
It's
you
the
muted
opposite.
yourself to speak.
Darn. See,
So
the cough button worked in reverse.
Exactly. So it was the exact opposite. So Doug's great with the financial. This is why they, he's great with the financial advice, but the broadcasting
this is like
acumen.
The third best thing I do.
Right. Yes, exactly. Which is not bad. But our listeners very much enjoyed that. Like, and then then where is he when you start?
Oh my goodness.
What a disaster. So
I wonder if we can edit that out, but we'll
I
see.
don't think so. I think actually it adds to it. It adds to it. So you were starting to talk about the $3,000 rule, but your lips were moving to those watching the video, and your mouth wasn't, nothing was coming out. Go ahead.
That's great. So really what happens is the first thing you do is you take all of your losses against your gains. So you offset that. So it's however many losses you have against your gains. And then this has to do with you end up with more losses than gains. Admittedly, that might not be an easy task in the last 2 years because the market's been so good. But some people haven't done this in many years and might be sitting on losses from years ago on securities that just sort of withered away, and they're still sitting on their statement like it's painful to look at. They don't want to look at that loser. But this is how you turn that into a winner. So you offset your losers against your winners that you've realized that you've sold. And if you have more losses than gains, then that becomes a bucket. And that bucket you can take $3,000 a year against on your tax return against ordinary income. See, gains and losses, if they're long-term, are taxed at a much lower rate. So, the help of the offset is good, but it's even better if you take it against ordinary income and you're in a 40% bracket. So you get to take, that's just the number. It's always been $3,000. And then if you still have left over, this goes on your Schedule D. You can find it right in there. It says loss carry forwards. It books on your return and it rolls to next year. And you can if you had $30,000 and you never have losses more than gains and you never had another gain, you could just chip away $3,000 a year for 10 years. Now, if you have some gains in a year or two, it'll go against that bucket before you have to pay taxes again. So this is why it's such a good idea to get in there. And we can segue into worthless securities. I had a client in this situation where they had Sears stock as an example, which went bankrupt. They were sitting on a big loss. It was just sitting on their statement. They came in, and the first thing I did in going through their statement is I'm like, do you realize you're sitting on this big loss here? And they're like, yeah, it's like worthless.
But they don't want to look at it, probably. They won't even think about it at first.
Oh, and they got a story and they're like, oh, but it's turned into the next, this happened with GM stock, things that go bankrupt and emerge in a new version, but the old stockholders are made worthless. Well, you have to book that loss. And so now there isn't a market for it, but where you hold that security in any investment firm, there's a disposition of worthless security form that they'll make you sign, and then they'll book that loss onto your return. You could do this before the end of the year. And now you've realized that loss. It's not coming back in this case, because sometimes if something's down, you're like, oh, I don't want to sell it in case it comes back.
It's out of business. Yeah,
this is out of business, and it's a big loss on paper. It's staring you in the face. Book that loss. You're not going to get any money for it, or sometimes the firms pay you $1 just to make the mechanism happen so it shows up on your tax report that you can put on and give to your accountant. But book those worthless security losses is something that, so we did that for them, and now we have something to work against for other gains for a little while. And we didn't buy it, but they came in with it, and I was like, you're sitting on this, let's do something. And they had no idea. And so nobody's telling them this, or they're not looking through it. And that's one of the things I'd look in there. Invariably, people do have these things that creep into their accounts. If you've bought some things, not everying's going to go straight.
I notice every little thing. I noticed how you worked in we didn't buy it, because this client came in, this guy, I don't know what he was thinking, but he bought this stupid stock. Well, I was the last part. I told him it was stupid. I said, don't
Seemed
do
like
this.
a good idea at the time, I guess.
Yeah, it wasn't my advice, but I still got to help him out, even though he's a moron. That's basically what you said. I hope this client's not listening now.
Oh my goodness.
Oh, that's funny. That wasn't our idea. So the other thing that I did want to talk about, speaking of things we talked about on the on the show that we a little bit more time maybe to dig in here. You talk about selling these losers to offset your gains. Then there was another line on the sheet. I remember it that day. It said taking gains to offset losses,
Yeah.
and you were kind of using a reverse, engineering. This had because we were talking about this the wash sale and the whole thing, but now kind of the opposite, at least in the wording.
Yeah.
But you meant by that what? And you can
I
explain it
love this
how?
strategy. We do this a lot. So if a client's sitting on or comes in with some booked losses, you could see it
Right.
on the return, and they got that bucket of loss carry forwards, and now they have some stocks that are at a gain, like Nvidia or something that's gone up a lot.
Sure.
It goes all the way back to their original cost basis. So let's just say they're sitting on a $30,000 capital loss, and they've got some stock that has a $30,000 gain. You could actually sell the stock and buy it back immediately because there's no 30-day rule when you're going to realize a gain. It's
Got
only
it.
on a loss you have to avoid. So sometimes you could just go out and back in because you love the stock and you want to keep it. But that move of selling and buying realizes the gain. So in this case, if you had a $30,000 gain on Nvidia,
Hmm.
you sell it and buy it back, you reset your cost basis now to the current price. And because of those losses, you're going to offset them. It's not costing you anything. But what it does is, should that stock continue to go the next couple of years,
Yeah.
now you're only paying taxes on it in the future from the current point, not all the way back to what you originally paid
Right.
for it.
Yeah,
So
because people think buy and this thing's going up. Why would I ever sell it? But
exactly.
there could be a reason. You're saying you use that a lot with clients when they come in
We
this?
do when they have the situation, because what happens is people get handcuffed with the stocks that they own. Here's a common refrain: they buy something and it goes down because the sell strategy is the problem. Well, I
Yeah.
can't sell it now; it's down. I'm just going to wait for it to get back up. So that's when are they selling it? They're not, like, there's just the sell strategy that's so, or they buy and it goes straight up and they're like, well, I can't sell it now; it's up so much. And so then it becomes too big a part of the portfolio, and now you really can't sell it. So what's my exit strategy for this stock? Well, these are some of the ways that you can maneuver around it,
Okay.
because at some point, unless you die with it in a non-retirement account, no one's getting a step up on that. You're going to have to pay taxes at some point. And I see people that later on that maybe growth was great, now they're moving into retirement and they might need income. Well, you got to turn your portfolio over and take you're going to pay some taxes. And it could very well be that 5-10 years from now, tax rates are higher than they are right now. So you
Yeah,
could be
right.
there have been times since I've been doing this where we don't have the special capital gains tax treatment. It's ordinary income. And so, sometimes in a lower tax bracket, it pays to do these things and step up your basis so that later on, if we don't have all that preferential treatment, now you're only paying from that point, and it helps you later. So it's looking at those strategies. And again, before the end of the year, get in there, take a look. Could I sell some gains against some losses? Worthless securities. Do I take some losses against some gains? Those are the things you want to do. And your accountant isn't going to do this in December. They're going to look in April and go, hey, what'd you do last year? That's kind of what happens. So,
Right.
with your advisor or yourself, open those non-retirement statements, take a look and see what you might want to do.
No, that makes a lot of sense. I think there's a lot hidden here. There's a few other topics I think we want to get to here. Episode number 5 of No Dumb Questions. Talking about year-end tax tips. You have some athletes, right, in your client base, don't
We
you?
do.
Also, or no? Yeah.
We do.
Have you talked to Juan Soto since? No,
No. Well, his advisor, I'm sure, is going to be very happy.
you wouldn't want a Yankee fan anyway doing those numbers. So
Not
that would be.
now.
I would like to see his charitable deductions. Anyway, so speaking of which, well, I wanted to get into that. Maybe some gift taxes too, because people think of that, especially around the holidays. But you also had rounding up on your deductible expenses by doing that. A lot of people take the standard
Right.
deduction. I guess some people itemize also. Not I guess, obviously some people itemize as well. So what's the thinking there in terms of deductible expenses this time of
The
year?
vast majority of people do not itemize any longer with the higher standard deduction. Now it looks like if
Right.
the new government's going to extend that, it's going to be a similar situation. But what happens is, it's always worthy a look to figure out if you should itemize. And nearly every accountant that I've seen that does return runs it both ways. Do you itemize? Do you take the standard? And if you're close to itemizing, like maybe you're going to take the standard deduction, because for married couples this year, it's over $29,000. You'd have to have more than $29,000 in deductions for it to make sense to consider itemizing. But if you're high in there, you can bunch up expenses, advance them into the year, and get over that to itemize. Otherwise, you're just going to take the standard every year. Or if it looks like maybe your income isn't going to be as high next year and you have something that's pending here in December, push it to next year so you can run your numbers up for deductions. And so just strategically, when you have those extra expenses that are deductible, and it could be medical expenses, it could be things like that
Right.
that you're bunching up into a particular year if you're very close to that sort of standard deduction number. If you're not anywhere near it, don't do that. But sometimes people are very close and don't realize that by adding some other expenses in or deferring it to next year and doing it then, you get over, and now you can itemize. So just know where you are in that limit.
Interesting. Now, I said I want to skip ahead or just talk anyway about
Mhm.
gift taxes and what people should be thinking about, giving away this time of year. And and then that
Mhm.
gets into charitable giving a little bit too, and the
Sure.
money you can save on taxes there. Also, you maybe just don't be a jerk and give some money to charity, right? What are we worried about taxes? I
Right.
mean, oh God, it does sound terrible, doesn't it, to say when you're talking about giving to charity? You should be doing it anyway if you can afford it. But
Yes.
now we're trying to
Yes.
save a few bucks on taxes. You rich,
Some
arrogant.
people
No,
are
never.
motivated by that tax break, and certainly the wealthy with their charitable foundations. That's
Yes.
I'm just saying. I'm sure they're all altruistic, but it certainly helps when they can
So
shelter all that
the
money
gift
from
tax
taxes.
is interesting, right? So there's that limit it's gone up a little bit, but so what can you give away, or what should you be thinking about, giving away without having to file gift taxes at this
Yep.
time of year?
So the number this year is $18,000. You can still do that anywhere before the end of the year. And
Okay,
I find a lot of times parents or grandparents want to help out their kids and they want to
sure.
give them some money. And so that's the maximum. Each person can give up to $18,000 to any other person and not have
To
to
one
file a
person, but
gift
they can
tax
give it
return.
to a bunch of people. They can give, if they have a
Right.
lot of money, they could give it to, well, they have about 10 kids, they could give them all that much,
They
right?
could, and the husband and the wife can each give. So I've seen,
Okay.
and depending on the situation, sometimes people are like, "Listen, I might go into this." You're thinking about your parents and grandparents. Maybe they're going to go into a nursing home in 6 years. So there's a 5-year look back. So maybe they gift a bunch of money this year, get it out of the estate. If it lasts more than
Right.
5 years, that's excluded. And here's what happens: the husband and the wife can each give 18,000. So that's 36,000, and then they can give it if their kids are married and have kids to the son, to the daughter-in-law, to the children. So you can push out, $36,000 per couple out to each person in the
Sure.
in the family and
Because
get
if
a
you
lot of
go over
money
that,
out.
if you give them, one person gives them $100,000 or whatever it is, then you pay taxes on whatever's over the
Not
18. Is that how it
well,
works, or
actually,
no?
what happens is you have to file a gift tax return, and it goes against what's called your unified credit. And
Oh,
right now, the amount of money that each person's allowed to give away in their lifetime is over $13 million. So you're just going to go against that 30. Now, if the current laws don't get extended, that number drops to 7 million, 7.5 million. But most people in their lifetime aren't going to be giving more than that
no,
away. Right.
no.
But so if you gift in this example, let's say you're one person and you want to give your kid 50 grand. I hear this all the time. I want to give my kid 50 grand towards a house. I'm like, be careful how you do it. Because technically, if you're one person, only $18,000 is allowed without filing a gift tax return. You have to file a gift tax return for that 32,000. Now, it's just going to go against your 7 or 13 million, but you need to book that on paper that shows that you gave that away. One day they may lower that number and then maybe you have less to give away later on in your state. Or be smart about it. If you're a husband and wife, give your son or daughter, in this case, $36,000 by December 31st, and then give him on January 2nd the difference to get to 50, as
Right.
long as, and then you don't have to file anything. So just, but people do this all
It
the time.
is interesting. It is kind of an interesting point. Again, it doesn't apply to a ton of people when you get into the higher numbers, I
Mhm.
suppose. But like, but to answer the first question that I was talking about, if you did, say someone had $1 million, I don't know, whatever, like a big number they wanted to give to someone,
Mhm.
they're not necessarily killing themselves on tax as long as they don't hit that huge number down the road,
Right.
which is now
Right.
13 and will be 7. So it's not that big of a deal necessarily, but
No,
it
but
just
what
becomes a
happens is,
paperwork issue, and they have to
yeah, you just
file
have to
it. And
have it on paper. But what does happen is then the future dividends and interest and earnings off of that now are shifted over to the other person who's the recipient. You
okay.
can also gift,
Hmm.
it doesn't have to be cash. It could be stock. But you have to be careful if you gift stock to your kids. This happens too.
Right.
People don't realize if you gift, let's say you gifted your shares of Nvidia to your kid and you bought them a long time ago. Well, when you gift that over to your child, they now inherit the original cost basis
Sure.
of when you bought it. So, just be smart about what you're giving them. Obviously, the best thing to give them is cash because there's no, gain or loss there. But you don't avoid the tax. You might be transferring
You're
that
still giving
tax.
them, by the way, if you give them Nvidia and you had a low cost basis on it, you're still giving them a pretty nice gift. You're sticking them with a tax bill at some point.
Correct.
But they should still be grateful. Let's not have children.
And they may be in a higher tax bracket than the grandparents sometimes.
That's true.
Because they're in their prime earning years and so you have
No,
to
that's
just
true.
take a look at what's my goal? What am I trying to accomplish? What's the best way to do it? But there are some things that everyone should get out their statements, take a look. What am I dealing with? What should I do before January 1st rolls around? And now this year's over. And now you got all year next year to look at what to do.
All right. I think we gave people most of what they could use here. Anything you want to get into at the end, whether it's charities or anything people should be thinking about, but that we didn't get a chance to hit on before we, really put people to sleep. I don't want to keep people going on and on about this for hours. You know what I mean? But maybe there's one or two other things. Is there, or do we hit most of it?
Just a real fun one is that for anyone who's a new homeowner that bought a new home, and the maximum you can take on your property taxes is $10,000 in the new rule. Now maybe they change it, but it's 10,000. And people, when they buy a home, they might not, if you bought it in the last couple of months because who you bought it from already paid the taxes, you might only have a couple $1,000s of property taxes this year paid. Now next year you might be paying more than that, so you're gonna hit the cap. But if this calendar year you haven't paid the $10,000 and you're a new homeowner, you can look to see if you can prepay some of those taxes now and book that into this year and pull that deduction into this year. So anyone who is a new homeowner or knows a new homeowner, have them take a look. Their closing statement will tell them how much in taxes they're going to be taking for this year. And if all they have to do is just know what the next bill is going to be, pull that ahead and throw that in if you can, and get that deduction up before the end of the year. So that's a fun one, and new homeowners don't think about it. Most new homeowners are fully broke anyway, so they may not be able to have the extra money because they just spent all their money on the house. But if you're in that situation, or there's some gifting around that you have extra money, you're going to pay less next year by pulling it into this year. And the key is you might get more of a tax break. So that's what I like.
What I like about a lot of this is it's stuff that people wouldn't necessarily think of because they're thinking about something else related to, like you said, when you're buying a house, you're thinking about a million other things, and you don't think about the tax implications. And sometimes with stocks, you're thinking about all the how much money you lost, and you don't think, well, you know what? Let me turn this lemon into lemonade, or whatever cliche you want to use. So that's the type of thing that this is the time of year to start thinking about. So I'm going to say that was our best podcast yet. Don't you agree? I mean,
great. Except for my cough. I think it was fantastic.
No, that was my favorite part, as a matter of fact. That was it. It humanizes you. Otherwise, people think, wow, well, this guy doesn't. He doesn't.
It's a guy in a suit,
right? So yeah. So if people see our posts on social media about this podcast and you have an idea for a future one or whatever, might as well just leave a comment there. I'm at Connell McShane on all these platforms. I know Doug is at Doug CFP on the Instagram, and then on X, it's the firm, right? It's at Flynn Zito. At Flynn Zito at the firm. So we'll post about this. We'll have it out there on YouTube, and then obviously for all those of you listen anywhere where you get your podcast, then leave us with a comment, and maybe there's some topics within financial literacy you want us to get into as we go into the new year. But that helped us, and then we'll be going. This is a good preview for people who watch News Nation, right? Some of these
definitely
tax tips will be coming up the next couple of weeks. We already did some, and then
Tax
some
Tip
other
Tuesday
ones are coming up the next couple of weeks. And since we spent so much time today, I won't feel bad cutting you off. So for Doug Flynn, I'm Connell McShane. This is No Dumb Questions, the podcast. We'll see you next time. Thanks for listening.